Good afternoon, everyone, and welcome to our TradeStation webcast on Tuesday, August 29th, 2017. Our topic today are the secrets to trading the yield curve. I want to welcome you to Bond Trading Bootcamp, presented by Jonathan Rose, the owner of Active Day Trader. Mr. Rose began his career on the floor of the Chicago Mercantile Exchange as a pioneer of computer-based trading. He was a key player in providing liquidity to the young Globex market, and after 5 years trading those NASDAQ futures, he was recruited to join a technology-focused fixed income trading firm. That's the beginning of the story, and so I'll let Jonathan talk about the rest of the story in one moment. As a matter of news, yes, we are recording. The recording is on right now. We will have the recording posted, and it will be in the Video Archive YouTube channel that TradeStation operates. That link is just above Joan's question in the chat panel. So we have a recording going, and so for anything that you need to review, that will be available to you in the next couple days after we scrub out any of the any inadequacies in the tape. So, my name is Don Prattle. I'm the Director of Trader Development and Education here at TradeStation, and I want to remind you that our presentation today is for educational purposes. All the symbols, all the trading ideas that we discuss are for demonstration purposes. They are not recommendations. This offer is also not an offer or a solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including, but not limited to, Hong Kong and Japan. Active trading is not suitable for everyone. Options trading carries a high degree of risk and is not suitable for all traders. Now, in that chat box, I've included 4 pieces of information for you. The first 2 are risks and disclaimers of risk about the various asset classes and the characteristics and risks of standardized options, which we may or may not cover today. Certainly, the next one is a very important one. The TradeStation Events webcast is also, there's also a link to our website with our upcoming calendar, and then, as I mentioned a moment ago, a link to the video archives on YouTube. You may have noticed that the chat panel is privatized, and that means the presenters can see your questions. You may seem like you're the only person available, but you're not. We have a big room today, and we want to get to all of your questions, so feel free to type them in there. Jonathan will answer them at his whenever he can during the presentation. So with that, I want to point out that Jonathan has a long background in the industry, and certainly bond trading is his sweet spot, his teaching point. And so we want to turn things over to him right now for the Bond Trading Bootcamp.
Don, thank you very much. I appreciate that great introduction. So yeah, my name's Jonathan Rose. As Don was saying, today we're going to be talking about bond trading. Bond futures could be replicated using ETFs or options, but really the focus is going to be on bond futures. We already went through a risk disclaimer, but these are obviously educational videos. If I talk about specific levels, it's just where I see value in the market. It's not really a trade recommendation to any one person. Okay. So I'm so happy to be here with you today. I'm really excited. So I'm going to make a bold claim right from the start, and here it is. I'm going to show you a trade today that you've never seen before. Okay, kind of a bold claim, but it's going to be true. Okay, just wait and see. I'll lay it all out from the start because I want you to see that this is going to be different content than you've been exposed to before. So today we're going to talk about a unique approach to trading bond futures without speculating or guessing or hoping that the market moves in your favor. This, at least in my opinion, from the opinion of the Chicago Mercantile Exchange, this is how you trade bond futures. Okay, bond futures are used as a hedging vehicle, and they're used to trade the yield curve. So we're going to get into that throughout this presentation. But just like anything, it needs to be learned, okay? There's a lot of webinars out there that say trading is so easy that you can, kill it in the first 3 days. I think we all know that's not necessarily the case. This is a real trade, but it does take time to learn. Whenever I'm teaching this trade, and I've taught it to hundreds, it's always patience. Take 2 weeks, take 3 weeks, take 2 months to paper trade, really learn, prove that you can make it work and that you understand it, and then you want to get in and risk real money. I always like to say this, I appreciate everyone coming. You guys made an awesome choice for attending today's completely free webinar. Again, I'm going to show you something that I think you'll be pretty impressed with. So this trade may seem unique, it may seem different, but try not to think like that. It's only unique because you've never been exposed to it. So all I ask, guys, is just keep an open mind. If you trade bonds right now and you're killing it, that's great. Don't change anything. This will help you. If you trade futures, you're going to love this. It'll really open your eyes. And if you've never traded futures and maybe you just trade stocks or options, this will also benefit you because bonds are obviously one of the foundations of the global economy. And again, I believe this is 100% the correct way to trade bonds. I personally feel like it's the only way people should be risking money while trading bonds. Kind of interesting. So I sent over my presentation to Don and the guys. We went through a couple of different iterations. So this is actually different than I have. So excuse me if I sound like I'm getting caught up a little bit. What this is right here, this is what we're going to be talking about. And this is the implied treasury spreads directly from the mercantile exchange. Okay, so this information you get from the mercantile exchange, and it talks about 2-year against 5-year, 5-year against 10-year, 10-year against bonds. It's got all these names, all these different names. So I want you to see when we talk about these names, it's not like I made this up. This is not watching one of those YouTube videos and you see like the running squirrel trade or some silly name like that. This is directly from the mercantile exchange. So a little background. I wanted to just go over why I'm qualified to teach you bonds. Very important. That's what I'd like to know as well. Been trading for 18 years. That's all I've done throughout my career. I spent 8 years as the director of trading at a bond futures firm in Chicago. At that firm, I was the 6th employee. We grew the firm to over 100 professional traders, 200 employees before we sold out in 2011. That entire firm traded bond futures, and while at that firm, I was one of the top 3 producers. The great thing about this trade, and what I look for in all trades, it's logical. It really makes sense. We want the decisions to be black and white, because we don't really want to guess on the direction of bonds. We want to remove the direction and look at bonds as a relative relationship. So background, that's me on the floor of the Chicago Mercantile Exchange, trading NASDAQ futures. That's where I started my career. So I traded NASDAQ during 97 to 03. And this was when the NASDAQ was really, really volatile. And when it was like that, for those who remember how volatile the tech sector was, it was a really forgiving trade. It was an easy trade. And everybody was making money. It was an easy trade. But when it slowed down in 03 down here, we went from making money, say 9 out of 10 days. Me personally, I couldn't make money for 6 months. And I was just miserable. My confidence was blown. I didn't really understand what was going on. First 5 years, I've had really consistent performance. All of a sudden, down here in 03, the trade got really difficult. And I thought, did I lose it? What's going on? And what ended up happening, and it was the biggest lesson that I've learned throughout my career, you need to be in markets that are in play. And markets that are in play are moving around. So the reason it was such a good trade here was it was moving like crazy. The market had a tough time finding value, but when it settled in, volatility came out of the market and there really wasn't very much opportunity for traders. And that's when I left to go trade bonds. And I traded bonds in the beginning of '03, June '03, right when the Fed started raising rates. And when the Fed starts moving, they move really fast. They move rates from 1% all the way up to 5.25%. And then the next thing they did was about face, right? June '06, 5.25, all the way down to a quarter. So they were really moving rates around, which made it a very good trade. Again, it put volatility in the market. At that time, I was trading so many fixed income contracts, the Mercantile Exchange was flying me all around to their best events. Here's me with LPGA Tour superstar Natalie Gulbis, who I also had a secret crush on at the time. She didn't have a crush on me, unfortunately. But that was because we were trading so many bonds. Now, I highlighted the different areas when the Fed raised rates from '03 to '06, downtrend. When the Fed lowered rates, uptrend. It becomes a really predictable trade. And when you get into a trade like that, which is what I consider predictable, you only want to trade one side of the market. So right here from whatever, '06 to '09, when the Fed's lowering rates really fast, you only want to be a buyer. Okay? It's pretty clear cut in fixed income which way rates are going. Then you just have to learn how to trade them. So I thought about the 3 secrets to learning this trade. Number 1, bonds are a puzzle. You need to learn how to put that bond puzzle together. 2, being in the right bond is key. You want to be long what's inexpensive and short what's expensive. And then finally, once learned, this is potentially a very consistent approach to the markets. So let me stop here, guys. I just want to ask, I can't really see how many people are in the room or who's in the room, but can you tell me who here trades bonds? And if you trade bonds, maybe if you could put in ZN or ZB or TLT, or if you don't trade bonds, just put no. You can do that. That'd be really helpful because as I go through more of the education portion of the presentation, it'll really help just kind of get a feel for who's in these markets anyway. Sam trades the fight. There you go. Sam, do you only trade the fight or do you trade other spreads? Hey, Teo. Okay, TLT. So this will be great for TLTs as well. Now the TLT, guys, is going to be extremely correlated to the ZB, right? But the TLT is a 20-year basket, and they call the ZB a 30-year bond. The reason they're so correlated is because the ZB, it's really a 20-year. Okay, it's a 30-year future, it's really a 20-year. The ZN is a 10-year future, it's really a 7-year. Cool, Sam. Sam, do you trade for a living? So interest rates, bond prices. You don't really need to know this, but it's cool, so I figured I would add it in. Interest rates and bond prices move in opposite directions. Okay, you probably know that. I want to go through why they move in opposite directions. So let's say I buy a 30-year bond and I get 3% on that for 30 years. Yippee. Okay, $1,000 every year, I get $30. Now, in this example, and it's going to be a silly example just because I want you to kind of understand it. Let's say all of a sudden the 30-year rate jumps up to 10%. All of a sudden it jumps up to 10%. We hold a 30-year bond that's only yielding 3%. So how are we ever going to sell that darn thing if rates are now 10%? We obviously don't want it, right? We'd rather have 10% than 3%. Well, as those interest rates go up, the price on our bond is going to get smushed. It's going to get destroyed. So if we want to get rid of that 3% 30-year bond, and we bought it for $1,000, we might have to sell it for $100 or $200. It matures at 1,000, and that's the way you could pick up that extra return. So let's talk about the bond puzzle. Oh, that's the wrong thing. So bond puzzle. First, relative value. When we say relative value pair trading, what that is, guys, is we're looking for two correlated items. So think of Coke against Pepsi. A big pair trade was Blockbuster Video against Netflix. A lot of people will trade gold against gold, right? If you have US gold versus European gold, kind of the same thing. Gold is gold is gold. The only difference that you're trading is a little currency risk between those. So when you trade relative value, that's trading one thing against the other. Ads, corn versus wheat, soybeans against corn. You can do 100 different kind of combinations. Before we get into fixed income, I'm going to go through an example using diamonds. And I'm also going to say I don't know anything about diamonds, except for the one that I overpaid 12 years ago when I married my beautiful wife. But let's say everybody in this room, we're all going to a flea market together. And it's a one-day flea market. It's very active. And all they do is they trade diamonds, and they trade 4 different kinds of diamonds. They trade a 1 carat, a 2 carat, a 3 carat, and a 4 carat. And when we walk in, these are the prices. Now, 5 hours later, we're all going around trading our diamonds, and the prices move. The 1 carat doesn't move. The 2 carat, it goes up 33%. The 3 carat stays the same. But look at the 4 carat. The 4 carat really, really rallied. There's a lot of demand for that 4 carat. Now, in this example, if we had inventory of 4 carat diamonds, maybe we would all decide, hey, look at the return we just got from the 4 carat. Maybe we should sell those. Maybe we should buy some 3 carats, because why did the 4 carat go up so much, but the 3 carat didn't go up? What would happen if the 2 carat was higher than the 3 carat? Is that sustainable? If the 2 carat got more expensive than the 3 carat, is that going to be sustainable? Or will it inevitably knock itself back in line? It seems like it's inevitably, if you get 3 carats, it's going to be more expensive than 2 carats. This is how we look at the bonds. But instead of gold, instead of diamonds, we're looking at the yield curve. And we're looking at the liquid contracts that trade at the Chicago Mercantile Exchange. There we go. So the 2 year is going to be the ZT. The 5 year is going to be the ZF. 10 year ZN, ZB, and UB. All this stuff up here, that's euro dollars. We're not talking about euro dollars right now. What we are talking about, though, is we don't want to guess whether rates are going higher or rates are going lower. We can have a little bit of bias, but for me, I trade for a living. I'm not willing to kind of cross my fingers and speculate. But what I want to do is I want to trade the difference. And if the 5 year future contract goes up or goes down, maybe a hedge fund comes in and sells 10,000 5 year future contracts. If a hedge fund comes and sells 10,000 5 year future contracts, supply and demand is going to knock that down, right? Well, if that's the case, and we were looking to buy one of the futures, we don't want to buy ZN, we don't want to buy ZT in this example. We want to buy ZF. We know ZF is inexpensive because in this example, that hedge fund just knocked it out of line. So if this is the yield curve, right now, this would be what I refer to as a kink in the yield curve. So it looks smooth here. See if I can get my nifty pen to start working a little bit. Right, it's here, but then it's got a kink. And we want to get that kink back in line. So we're going to be buying that ZF. You could also hedge yourself and sell one of its neighbors. Same thing with the ZN. Who knows what could happen? Supply and demand knocks it out of line. But again, the ZN is definitively expensive if this happens. And just because the ZN goes higher absolutely does not mean that the ZB and the ZF are going to follow, right? It's supply and demand. It's not a controlled market that all of a sudden the ZN rallies and everything has to rally with it, right? We're traders. The role of the traders is to keep the markets efficient, to keep the markets in line. So that's why we're looking for opportunity like this. Same thing with the ZB. Yeah, so I got a few questions just talking about the chat. The chat's set on private. Whatever questions you guys have, you can just throw them in there and I'll get to your questions, as long as it's kind of not really breaking the rhythm of the presentation. So same thing with the ZB. I think you guys get it. But what we're really looking to do, guys, is ZN, ZB. These are highly, highly correlated. These have about an 80% correlation. So if they start moving independently from one another, that can possibly present the trade. Think of it like a rubber band. If you have a rubber band, you can pull that rubber band. Well, what's going to happen? Right? It's inevitably, it's coming back. That's how we look at these. And so what this trade is, it's a relative value. It's also called a pair trade, but it's also a mean reversion trade. And it's a mean reversion trade because of the very, very high correlation between the different instruments that are on the yield curve. Now, earlier when I showed you that CME sheet, this is what it was showing. And so 2s, 5s, the spread between 2s and 5s is called tough. The Chicago Mercantile Exchange made that name up. The spread between 5s, 10s is called the fight. The F for 5, T, 10s, fight. Knob, and this is called the bub. It's the 30-year against the UB. Now, when I say put that puzzle together, let's do it. Let me do a little example here. Okay. So when I say put the puzzle together, let's say 2s against 10s. Now, if 2s is trading 1% and 10s are trading 4%, okay? If we definitively know that to be fact, okay? 2s, 10s, we know it to be fact. 100%, it's trading, 3%. 4 minus 1, it's trading 3. If we have that information, then we could also value the pieces of the puzzle. 2s, 5s, and 5 10s. Because if 2s, 10s equals 3, we also know that 2s, 5s plus 5 10s has to equal 3. Daniel, I can't see everyone, so it might just be me and you, but I don't think that's the case. Does this make sense? Now, I'm going over all this, guys. I don't expect you to understand everything. I just want you to see the possibilities. And the key here is if 2s, the difference between the yield on 2s and 10s, if we know that, then we definitively know the different parts of the puzzle. So if we know what the tut is trading at, we also know that the tough plus the fight equals this guy. It has to. It's a part of it. It's like if we know the difference between 3-carat diamonds and 1-carat diamonds, we also know that the difference between 1s and 2s and 2s and 3s has to equal 1s, 3s. It's just math. This is an example right here of the knob. And the knob is 10s against 30s. And whenever we do these trades, we have to do a formula. Okay? I have to teach that. But the way this works is, again, if this is the yield curve, and this is 10s, and this is 30s, we're just trading this part of the yield curve. This chart doesn't show anything else except this little part of the yield curve. And this is the behavior. Right now, the knob is very, very, very expensive. Right now, the bub which is our next chart. And again, let me put the yield curve on here. And if this is 10s, if this is 30s, and this is ultra, this chart here is just showing this piece. Okay? So earlier, 10s, 30s was this, rally, rally, rally. But at the same time, this piece, which I just showed you the other chart, is falling. So there's a big, big disconnect between this part of the yield curve and this part of the yield curve. Why is there a disconnect right now? Well, what happened last night that's kind of unprecedented in the overall market? A little bit of volatility last night, right? A little bit of uncertainty added to the market, more than there was at least the previous day. So that's why there's such a big disconnect between these two spreads. And that's why there's a really good trade opportunity right now in these two trades. Before I move on here, do you guys have any questions on the yield curve portion when we start talking about this? Does that make sense to you guys? I mean, obviously, it's a different way of looking at it. Most people speculate. But what I want you to see is for those that are just trading the ZB or the TLT, you're really at a significant disadvantage. Teo, you're awesome. Teo says, I always make great sense. But Teo, this is probably like the 20th time that you've seen me teach. So the overall, what I really want to show you is that it's a free market, right? It's driven by supply and demand. Let's say China needs to come and buy 1 million 10-year futures, 1 million 10-year future contracts. What's going to happen to the 10-year future contract? China needs to buy them. Going higher. Absolutely going higher. Yeah, the other ones will try to go higher, but it doesn't have the demand that 10-year has. So as it rallies, as traders, we want to sell it. And then we want to buy other things to protect ourselves. And that is what we start calling a butterfly. And that's how we could start trading the yield curve. Okay? Chris, we are trading flattening or steepening. Absolutely. That's exactly what we're doing. Over time, the yield curve could be really steep. It could be kind of normalized. It even could be flat. It could be inverted. And so what we're doing is we're trading the kinks of the yield curve. We're looking for highly reliable trades. We're looking to buy one and sell the other one, keeping it nice and simple. Okay? So usually at this point, people fall into a few camps. One camp is they're blown away. They feel like this is exactly what they're waiting for. They're having a little aha moment. Now, the second camp is interesting. I like it. I don't really get it, but I like it. And then the third camp looks something like this. Completely overwhelmed. Okay? How many of you guys feel overwhelmed on what we just talked about? Or how many are excited on what we just talked about and you see the possibilities? It is a more sophisticated approach than I've seen presented. I also don't know anybody on the internet that's teaching this exact trade. And again, my background is I learned this trade 2003. I was the 6th employee of a bond futures firm that only traded this. And at 2011, we sold to a major hedge fund. Okay? Chris, good, you got it. Nice. Okay. So however you feel, I really want you to see, first of all, that trading doesn't have to be all on guessing on direction and trying to get lucky. Okay? Hopping on momentum or hoping to catch a breakout. I really think there's a better way. And I think for some of you, you're going to be really excited about this approach to trading bonds. So if it's okay with you guys, I'd like to take a little bit of time, introduce you to the bond program. This is the same program that many of my clients are doing full time. So I put up a testimonial in the previous presentation. I guess I won't go into a presentation. A testimonial that I can't actually show you. So here's how the bond program works. I break it up into 3 levels. And I often speak video game parlance because I have an 8-year-old and a 10-year-old who play way too many video games. So level 1 in bond trading is all about butterflies. It's all about outright trading. So we teach you how to build those butterflies, the math behind them. It's straightforward once you learn. And level 1 is all about outright trading. Level 2 is going to be trading spreads. That's when we start getting into the knob and the fight and the bub and all those cool names. Okay. Level 3 is going to be more of valuing the yield curve, really looking to take those kinks out of the yield curve, building positions, maybe trading a little bit of a steepener or a flattener. That's going to be level 3. What I also include is easy to read margin sheets, contract info, etc. So that's the first thing that it includes. It's a 3-hour on-demand class that teaches you everything you need for the trade. The next thing that you're going to get is something we call Fed Dominator. This used to be a separate product, but we wanted to add this into the bond program because there's no reason to break it apart. This is kind of like level 1, learning how to do the butterflies. It's all about outright trading. So we combine the two. And if I put those on top of one another, you get the 3 hours of the bond trading bootcamp, and then the Fed Dominator, which is a 90-minute recording. So that's 4.5 total hours so far, but there's more to come. I also put in a 10-page PDF. This 10-page PDF shows you exactly where each bond was trading from 2003 to 2007 when the Fed was raising rates, and then from 2007 to 2009 when the Fed was lowering rates. So these are, again, a little out of order, but I've heard it from so many people that, trading is so easy. It's not that it's that hard, but you need to put the time in. So right from the start, guys, I just want to be very, very upfront. This does take time, but if you're committed to learning, being able to invest 2-3 weeks, 1 month, 2 months into really understanding the trade. So you should paper trade. I think everyone should be paper trading whenever you try something new. Prove to yourself on paper that it works. Then after that, do that for a week or 2 weeks, proving that you can get a return, and then get in there with real money. I see so many people want to get in and risk money right away. And what ends up happening is you start digging a hole. By the time that you really understand, your $40,000 account's a $32,000 account. So you spend all that time building it back up. Patience, patience. From my experience, the tortoise always beats the hare when it comes down to trading. I'm all over the place. So jump to the it's $297. That's everything. There's one more bonus which I'll get to, and then I want to open it up for any questions. I'll just hop right to the bonus right now. We're doing a live class. The live class is going to be September 4th. It's 60 minutes long, and we can go through the boot camp. We'll go through any questions that you have. Okay, so for anybody who's interested, it's going to be activedaytrader.com/Fed. It's 4.5 hours on trading boot camp. There's also that PDF, and there's also a live class that's going to be offered on September 4th. 30-day money back guarantee. If it doesn't work for you, it doesn't work for me. No questions asked. Okay, this needs to work for you for it to work for me. We definitely missed some slides. So I've been going through this. We definitely missed some slides because TradeStation, why this makes so much sense for TradeStation is when you trade spreads, if you're using a platform that doesn't give you exchange guaranteed spreads, if you put on a ZB and then sell a UB, you can do one minus the other. For most companies that don't give you exchange guaranteed margin, you're going to pay $5,000 of margin on ZB and $5,000 on UB for $10,000 of margin. What TradeStation does, because in my opinion they do margin correctly, is they offer exchange guaranteed spreads. So if you're long one ZB and you're short one UB, they're going to give you the margin rate that the CME provides through their span calculation or something like that. So I asked the fellows earlier, that same position that would be 10 grand somewhere else is only $1,500 with TradeStation, that ZB UB. Pretty significant difference. The other cool thing that I'm doing with TradeStation is TradeStation is going to rebate any one of my clients for new accounts 20% of the commissions, and you can use that towards 100% of any dollar spent at Active Day Trader. So you move forward with the bond boot camp, you start trading 20% of your commissions. Once that equals 297, it's a wash. So pretty cool deal. Okay, so that's kind of everything. I'm sorry, definitely the PowerPoint and the PowerPoint that I'm using, there's little subtle differences. It was kind of out of order, but I want to go back and just make sure we answer any of your questions, because this really is a cool trade. It's a really powerful trade, but most important, if you're just trading ZB, especially for those guys, I want you to see that you're at a significant disadvantage. So if you're selling a bond contract, don't only be committed to ZB. You need to be open to maybe ZF is the most expensive. Maybe the 10-year is the most expensive. Maybe the bond's the most expensive. Same thing when you're buying, the opposite side. You only want to buy what's inexpensive. Okay? Even if technically something's going to break out. Okay? Sam is saying, can you speak to your track record in this trade? What can we expect for an annualized return? So, Sam, good question, fair question. So what can we expect for an annualized return? I can't answer that at all, because if you have 10 traders, specifically with this trade because it needs to be learned, you're going to have 10 different results. When I was with the trading firm, we had 100 traders. We had some traders who were making $3 million a year, and we'd have other traders that were losing money in the same exact trade. So what can you guys expect for your annualized return? I'm not going to answer that. I don't know you, but if you're willing to put the work in, I can tell you that I've trained over 100 professional traders on this exact trade. Those who come in and are willing to do the work, those who don't rush into the market, those who prove it to themselves that they can make it work through paper trading. From my experience, those are the ones that I've found had the best success. You guys can also email me at Jonathan@ActiveDayTrader or support@ActiveDayTrader as you're going through the content, and I'm happy to answer any of your questions. Okay. Sam, my track record, I've done nothing but trade my entire career. Sam, no. This is, so great question. Sam is asking, is this a market making strategy? Meaning buying bids and selling offers and hitting the other side. So I think the way to answer that is with time frames. So the trades are going to be anywhere from like an hour long, and they could be up to a week long or a week and a half. What we're doing is trading value. So if we find something that's expensive, we're willing to commit to one side. But we're not looking just to hold it and cross our fingers. We're going to look to put on a position and protect. So if we're selling a 10-year, we're going to be buying something as protection. Oh, Sam, you got it. So same thing, if we look at that yield curve and we see that 10-year, using price, it starts getting expensive because who knows, it could be getting expensive for tons of other reasons. We want to sell that. For me, we want to buy protection. Okay. Just like for you option traders out there, at least when I'm trading options, I want to trade hedge. I don't want to only be long options. I want long options. I want short options. I want long exposure. I want short exposure. I want to be long vol and short vol. Chris, the average drawdown on trading one by one is maybe $300. You have to learn the formulas, so that does need to be taught. So the average drawdown on a little butterfly like that, I don't know, $300, $400. I've had clients who've been in this trade for as little as maybe 8,000. Just as an idea from what I've heard from the clientele. So how this works, the bond program at Active Day Trader. So I'm pretty straightforward with the products that we offer. It's bond futures, and I was a market maker on the floor of the Chicago Board Options Exchange, so I can value options to the penny. Those are my two core competencies. So the bond program, there's 4.5 hours and a live class. And that teaches you everything that you need to know about this trade. Now, for those who want to take the trade further, I have a private Facebook room, and that's my advanced bond room. So the traders who really love this trade are all in there communicating, talking with each other throughout the day. So these are the only two things that I offer in bond futures. The 297, which is the videos, more of like the core class. And then after that, for those that really want to move forward with the trade and join that community, there's an advanced bond room. And that's where I spend my time throughout the day. That room, you really have access to me intraday. You still have access, email me, I'll get back to you as soon as I can. But the benefit of that advanced room is I have 50 traders in there, all kind of working together, kind of going back and forth. Okay. What we also do is back to that yield curve. If that 10-year, if there's a bump in it, and we think that 10 years expensive, if we're going to do an outright trade, we can just sell ZN. If we want to do a spread trade, we could sell ZN and buy ZV or buy ZF. Okay. Most important though, you have to learn how to do these in the correct ratio. So you can't just do ZN against ZB. Don't do that. Okay. You need to learn how to chart these, how to do these correctly. But again, and this is directly from the mercantile exchange. This is exactly how they teach how to trade bonds. Okay. Do you guys have any other questions about bond futures? All right, fantastic.